market. When markets go down, investors feel worse and worse. And pretty soon they panic and they sell out. Turns out most investors sell out near the bottom.
Right.
That is not the way to make profits in the stock market.
Right.
Study after study says
buy high, sell low.
No, buy low, sell high is our goal.
Right.
When Wall Street sells a product, they appeal to the emotions of the normal human investor. That normal human condition causes us to want to get the best returns. So what they appeal to is, look, here's what's doing bad, here's what's doing better, sell what's doing bad and buy what's doing better. And the track record of that is that it doesn't work long term, that broker doesn't know what's doing better any more than you and I would, or they're guessing about the future. So if an investor can buy and hold, they will outperform people who trade. So study after study shows that the more you trade, the lower your expected performance, actual performance, therefore expected performance in your portfolio. So if investors can buy and hold, then they'll get higher returns than if they trade, even infrequently.
Now, for the brokerage firms, though, they don't make any money unless the person trades, isn't that right?
Well, that's how they're compensated. Yes. They're paid per trade, not per profit.
Okay.
So it is the goal of Wall Street to get you to trade, do something, and they are extremely good at it. And they do it by presenting a whole bunch of information. Look, the interest rates went up, the interest rates went down, inflation's up, inflation's down, somebody went under, somebody hit the moon. Something happened, and now we need to do something. I don't care what, just something. Buy and sell something. In contrast to how I advise my clients, which is don't do anything. What we're going to do is buy the whole global marketplace. We're going to allocate for risk, and we're going to hold on. We're just going to make sure that that portfolio is diversified enough such that when any one market goes up or down, that makes up that portfolio, when any one market goes up or down, a client's comfortable with it because they know that it's just part of the total. But we're going to buy and hold. And our personal track record at our company is to get the returns of the marketplace and do it with the same or less risk as the market. So we are extremely successful at doing that.
Okay. Now, there are a lot of people that this business of index funds is just not very sexy. I'd rather go out and buy some Apple computer stock or some sort of stock, you know. I can understand that and so forth. Yeah, whatever. So why shouldn't I just? Why is it preferable to use these funds rather than buying individual stocks?
Well, certainly if you own one stock, you can bounce its price off the moon if you're really lucky and buy it real low and price goes up. That's exciting. That stimulates the juices. It makes us all really, really excited to have that happen in our portfolio. And if you have all your money in it, you were really, really, really lucky. The alternative is more frequent. The alternative being that it doesn't hit the moon, that it just kind of languishes around and doesn't do much, if anything, or worse yet, falls in value. The way to avoid the risk of owning, so there's a risk of it going to zero, and there's a risk or a joy of it hitting the moon.
Yes. Okay.
So the only way to avoid the risks that I just mentioned of an individual stock ownership is to own a portfolio of them. And a mutual fund is the best way to do that. So it's my opinion that investors should not own individual stocks. They should only own mutual funds. If you want to gamble, if you think any one stock's going to hit the moon, then we need to make sure that you've got discretionary cash with which you can gamble on that stock. Because if you lose it all, the spoken rule I have with my clients is you just can't come back for more.
Yeah.
So if you're going to go gamble and you lose it all, too bad, game's over, you don't get to play again.
I see.
But if you can keep that portfolio going, then in my opinion, and you have fun with it, it's something you should play with, but not consider as part of your retirement portfolio.
Mm-hmm. So you like gambling, go ahead and do some gambling, just recognize it for what it is. And it means, though, I mean, the way I see it, though, is that sometimes in order to get the big returns, you've got to take some big risks.
Yes.
And so you just recognize it, that I'm taking the big risk in the hope of getting a big return. But for the long term, we're looking for a more consistent type of a program, like for planning for retirement, children's education, that sort of stuff. Now, so people are going to ask, how can I apply your investment philosophy to my 401k account?
The best thing about a 401k is that it's available. The second best thing is when you participate in that and contribute the maximum amount of money. So yes, I absolutely recommend everybody participate in their employer's 401k and contribute the maximum amount of money forever.
Mm-hmm.
At the beginning, that's called dollar cost averaging. You're putting away $100 a month,
Mm-hmm.
and in the first year, you put away $1,200, and at the end of the year, your $100 was 1/12 of the total, plus or minus earnings. The problem is that after 10 years, your $100 a month doesn't dollar cost average the average price of that whole thing at all.
Mm-hmm.
So I like the concept of making annual contributions to a 401k. I like the concept of it being invested in stock.
Mm-hmm.
I like the concept of a long-term hold. You need to be willing to go into that 401k with knowledge that you're going to buy and hold those investments for a lifetime.
Mm-hmm.
A lifetime.
Mm-hmm.
Overcoming the emotions of market cycles is the problem with 401ks. With a phone call or a push of a button, too many 401k participants are eligible to sell off what they've purchased and, or worse yet, chase the latest, highest return mutual fund.
Mm-hmm.
So investors are likely to chase returns,
Mm-hmm.
and if it's easy to do it inside their 401k, they tend to do that.
Mm-hmm.
The result is that they underperform a simple buy and hold.
Mm-hmm.
So my recommendation is that if you're going to be, my recommendation is that you participate fully in a 401k plan, buy all the index funds that are available. There's normally 1 or 2 or 3 available. And you don't need to buy any more funds than just the index. If you don't have index funds available, choices get a little more difficult.
Yeah. We're going to have to wrap it up, Craig. So thank you again for being with me today. We have some contact information. For Craig, again, Craig Martin works at the Family Wealth Consulting Group, certified financial planner. They have a website, www.fwcg.net.
Yeah, good. You got it.
And I also have some contact information for myself if you're looking for help from a certified public accountant. My name is Michael Gray, CPA, and I have a website for this particular show. It's www.financialinsiderweekly.com. And if you have an idea for a guest, I would love to hear from you because I'm looking for people to participate with me and share information for this program. And you can email me at michael@financialinsiderweekly.com.
Good show.
And I'm looking forward to see you all next week. Thank you.
Great.